FunSupermart.com.
Hello everyone. The situations in some of the peripheral countries in Europe remains uncertain. Having said that, why should we stay invested in the region? Today we have Hugh, Head of Strategic Product and Marketing at Pioneer Investments, to share with us the investment story. Hello Hugh. What makes Europe an attractive investment story in 2013 and where are the opportunities?
The thing that makes Europe an interesting investment case isn't growth. I think growth is going to be very low in Europe. But what makes Europe interesting is a combination of two things. One, valuations are really cheap in terms of the equity market and also in terms of the additional spread that on high-yielding assets is achievable in Europe. And secondly, the fact that globally the world is very underweight Europe. So any sort of movement of investment flow to get even back to a neutral position is likely to drive asset prices quite a good bit higher.
The economic situation of the PIGS remains worrying. Meanwhile, Spain is proposing its budget plan for 2013, which aims to cut 40 billion euros from their deficit next year. So if the budget plan is approved, do you think Spain could fulfill the target in budget cuts?
I think in the periphery of Europe, the situation remains a concern, but I wouldn't underestimate the amount of progress that has already been made. 2 years ago, to think that the level of budget cuts that have already been achieved in both Italy and Spain would have been unthinkable. The other factor that has made a difference is the amount of structural reform, particularly on some of the flexibility of labour, has made quite a substantial difference. Spain has both a big target deficit cut to make. I think it has to, because if it doesn't, it will not have the credibility of the market and it will be forced to ask for assistance, probably through the OMT structure, which is still a potentially likely outcome. Spain has about 140 billion of debt coming to maturity in 2013, which it needs to roll over, and it has to do so one way or the other. And they will not get the assistance unless they deliver some of the targets that are being demanded by their European colleagues. So I think a lot of progress has been made, but it will require an ongoing determination and probably an ongoing market pressure to make sure that those targets are achieved. But I think it's achievable.
Do you see the OMT an effective solution in helping the region to step out of the Eurozone crisis?
I think the OMT is a game changer in terms of a solution because it does two things. One, it's an explicit exchange for obeying certain rules. There is an assistance, but the assistance is different to either quantitative easing or Operation Twist, in that it's focusing on a certain part of the curve, the shorter end. It's unlimited in theory in terms of the volume that it can be used. And that finally also, ultimately it's trying to target a certain level of market volatility because it will target a certain yield level as they will only intervene to maintain a certain yield level. That helps a lot, particularly short-term bond investors, particularly the money market community, which are starting to flow back into euro-denominated assets, not because the OMT has been enacted, but in theory that it could be enacted. And it will particularly try and reduce some of the volatility and price spikes and troughs that have been driving investors who have to market in the short term away from euro-denominated investors. So I think it is a very important development.
While the Eurozone debt crisis remains worrying, how do you see the situation play out in 2013?
The European Commission is lowering its growth forecast for GDP and to around 0.1% for 2013 for the Eurozone as a whole. Germany will continue to grow, and both Italy and Spain will probably be or already in a mild recession. That's an investment in the future. It's a little bit like a squirrel putting away nuts for the winter. You have less consumption in the short term as you have to cut some of the expenditure and raise taxes, so you're pushing down growth in the short term, but ultimately you're doing the right thing for the long-term future, like investing for college. So we're going in the right direction. I see growth being extremely low in 2013 and remaining low into 2014. But on the other hand, what I do see is progress in terms of both cutting the deficit to a sustainable level and structural reforms. So I'm more optimistic, but I think there's still quite a long way to go and a lot of work to do.
Lastly, what are your advices to investors who are keen to invest in Europe the coming year?
Yeah, I think for Asian investors in particular, I think that the value offered in two areas I think are interesting. One is equity valuation is attractive and trading at a significant discount for a region where a lot of the listed companies are big exporters, particularly to the emerging markets. So a very significant amount of the revenue made by European listed companies is outside of the Eurozone. So these are international companies that have been penalized by the sovereign issue of the euro crisis. So if the euro crisis doesn't get worse, in theory, equity valuations should normalize. And I think that the global investment community, which is very underweight Europe, will be getting back in order to get to a more neutral position. And that could be, a big driver of asset prices. The second thing is similar for high yield. Euro-denominated high yield offers about a 200 basis point spread on top of its US high yield equivalent. Again, not because the default rate is any higher, it's not. In fact, it's about the same or even lower than in US dollar denominated high yield. But it's been penalized by, again, the sovereign issue of the euro crisis. But the credit worthiness of the issuers hasn't really changed. It's just the fear that the euro would break up. I think there's a much lower probability of that occurring now with all the progress that has been made over the last 6 months. One other idea is for investors that are looking for income. A lot of investors have moved into bonds and they've moved out the risk curve to achieve higher levels of income and are in many cases overweight in high yield. And the outlook for an absolute return from high yield for 2013 is a good deal lower than it was in 2011 or 2012. An idea would be to start thinking about accessing dividends from equity and investing in equity not for equity capital appreciation, but actually for the dividend stream that it produces. The European equity market has a dividend yield of about 3.5%. If you invest in the high dividend portion of the market, you can get that up to about 4.5%, maybe even 5%. And to enhance the income further, you can write some call options onto some of the names in the portfolio where you don't think there's much capital appreciation upside to them to get a higher dividend stream, a higher overall income stream in the portfolio, which can be as high as, say, 8% in our experience. So it's one way of using what are in many cases almost investment grade quality names, but you're invested in the equity issue for the dividend. It's a way of creating high yield like returns, but in an overall strategy that could be more defensive were inflation to rise a little bit and make life a bit more challenging in the future for bond investors.